Printing $28.24 billion in Q2 revenue sounds like a massive victory, yet Tesla is quietly bleeding its discretionary cash today. How does a company achieve record-breaking top-line growth while its core profitability collapses to near zero? Are we watching a brilliant technological evolution or a catastrophic misallocation of capital? With the 26% year-over-year surge bringing trailing 12-month revenue past $100 billion, it is easy to get swept up in the market momentum. At first glance, most analysts assume the firm is firing on all cylinders. But the reality hits when you examine the operating margin, which plummeted to a razor-thin 1.4%. This severe margin compression occurred because operating expenses exploded by 47% year-over-year, reaching $4.35 billion. Management is pouring immense resources into unproven physical infrastructure like massive artificial intelligence data centers and humanoid robotic assembly lines. This reveals the true business mechanism driving the stock today, showing that legacy automotive hardware is barely turning an operational profit. The business is systematically sacrificing its near-term automotive margins to fund a highly speculative technological pivot. But to grasp why this is happening, we must look at a glaring discrepancy hidden on the income statement. Reported US GAAP net income came in at a seemingly healthy $1.11 billion. Headlines fixate on this sustained profitability, but miss that actual operating income was only $398 million. That represents a massive $716 million gap between what the company earned operationally and what it reported on the bottom line. The firm heavily utilizes non-operating items, likely interest yield generated on its massive bank accounts, to mask fundamental weakness in its physical vehicle manufacturing pipeline. This is a classic financial mirage that keeps retail investors calm, while the core business of bending metal and assembling batteries struggles under scaling costs. Once you grasp this dynamic, you realize true profitability is rapidly eroding. The company essentially borrows from its own treasury returns to subsidize factory operations, which is an unsustainable long-term strategy. This brings us to the real elephant in the room regarding how management funds these grand ambitions. Free cash flow flipped from a positive $146 million last year to a deeply negative $1.09 billion today. Wall Street largely ignores that capital expenditures surged by 142% to a staggering $5.79 billion. Tesla is aggressively building semiconductor plants and supercomputing clusters, betting everything on an autonomous future. The underlying reality is core manufacturing operations no longer generate enough discretionary cash to self-fund this vision. The narrative has fundamentally shifted from a self-sustaining cash machine to a capital-hungry technology startup demanding immense financial patience. This truly represents the ultimate binary bet for the business. Either these physical assets secure a generational monopoly in autonomous transport, or they become a multi-billion-dollar misallocation of capital. Before we label this transition a complete value trap, we must acknowledge a major structural silver lining in the revenue mix. Services and other revenue surged 50% year over year, hitting a record $4.58 billion. More importantly, services gross margin achieved a remarkable 14%, contributing a substantial $648 million in gross profit. While the crowd is entirely captivated by hardware margin decay, the company is quietly and successfully monetizing its existing global fleet. Through premium software updates, supercharging network fees, and insurance products, the firm builds a highly lucrative revenue moat. This high-margin safety net is crucial, as physical vehicle hardware becomes increasingly commoditized, providing the cash flow durability management needs to weather the transition period. And this is something you can easily check for yourself in all future earnings reports. But can the business actually survive this expensive, multi-year technological bridge? The answer lies directly on the balance sheet. The firm holds an impenetrable liquidity buffer, with cash and short-term investments sitting at a massive $43.52 billion. This fortress balance sheet allows management to aggressively outspend legacy competitors without ever needing to tap into restrictive debt markets. While rivals defend their hardware margins through sheer global volume, this company plays a completely different game. Simultaneously, we are seeing real traction in software adoption, as active full self-driving subscriptions jumped 56% to reach 1.48 million users. This ecosystem lock-in is intensifying rapidly, creating a captive audience that legacy automakers simply lack. When you combine this software momentum with physical demand metrics, a fascinating paradox emerges. Despite broader economic anxieties, global vehicle inventory sits at an exceptionally tight 15 days of supply. The consensus view often claims consumer demand is stalling, but 15 days of supply proves the exact opposite. It demonstrates that the production-to-delivery pipeline remains highly efficient and top-line demand is structurally intact. Furthermore, we absolutely cannot ignore the industrial foundation quietly offsetting automotive weakness. Energy sector deployment skyrocketed 41% year-over-year to 13.5 gigawatt-hours. This silent growth engine, featuring massive commercial battery installations like the Megapack, provides a highly formidable secondary revenue pillar while speculative robotics initiatives mature. Moreover, the business is constantly enhancing the user experience to maintain pricing power, integrating software upgrades directly into the cabin electronics. Yet, the central business conflict remains unresolved when you look at raw production figures. The company achieved record vehicle deliveries of roughly 480,000 units, growing 25% year-over-year, yet operating profits simultaneously plummeted by 57%. Selling more physical cars actually yields substantially less operating profit today. This fundamentally confirms that scaling automotive hardware is no longer the primary value driver for the stock. For an intelligent investor, this creates a profound valuation dilemma. You are paying a premium technology multiple for a business currently generating the profit margins of a traditional automaker. So, what does this mean for the pragmatic investor navigating this highly complex transition? We began by asking how a business prints record-breaking revenues while bleeding cash. And the truth is, Tesla is effectively functioning as two completely different entities right now. It is a maturing manufacturer burdened by supply chain bottlenecks, aggressively funding the birth of an unproven artificial intelligence powerhouse. The current valuation offers no traditional margin of safety based upon legacy automotive metrics. Instead, the firm demands investors look past the margin collapse and negative cash flow, trusting the $43.52 billion liquidity fortress bridges the gap. The real takeaway is that the fundamental thesis has permanently changed. You are no longer simply investing in a legacy car company scaling its physical volumes. You are underwriting a capital-intensive robotics startup where the ultimate payoff remains years away. This transition requires incredible conviction from shareholders. The next few quarters will prove if this ambitious strategy is genius or reckless. But I want to hear your take. Are these massive infrastructure investments the ultimate competitive moat or a dangerous drain on capital? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.